He'll come back.
Hey, good afternoon, everyone. Welcome to Ask Me Anything, BYOB edition with the Money Multiplier team. And we are here to answer all of your questions around infinite banking concept, becoming your own banker. And we can get into really any financial or sports talk as well. I mean, the Florida Panthers are rocking and rolling through the Eastern Conference playoffs right now, tied up 2-2 in the series. And the Las Vegas Knights are sitting at home, sucking their thumbs. So that's all I know. But we'll be right back at your questions in the chat box. We'll answer all those questions in about 14 seconds when we get right back. All right, and while we were gone, we multiplied. So we have two more money multiplier agents now.
Who added water? Who added
like
water?
Gremlins. Like someone got water on one of us and we popped out Joe.
If you're wondering what the background looks like, it says What the F, because we also have another show on Wednesday mornings at 9:30 Eastern called What the F Happened. So if you haven't seen that, join us at 9:30 a.m. Eastern in the exact same place you're in right now, either on YouTube or social media. And I'll flip that over to BYOB because we're on a different show now. All right. So with that said, I'm Stephen Nagy. I help all of you guys with creating infinite banking policies and education and hanging out with our team on a daily basis. So with that said, I'll pass it over to Jason Sipple. What's up, Jason?
Thank you, Mr. Snaggy. It's great to be here. Another AMA Ask Me Anything Wednesday. Beautiful down here in the city. Beautiful today. It is windy. It is warm. Just went in the plunge before this, and now I'm freezing. So I'm freezing after being in the plunge for a few minutes. Excited to be here with all you guys every week, answering your questions, helping you take back control of your money from the evil empire, which is the banks, which is Darth Vader, which is right here represented. So over to Mr. Carson.
Well, Jason, I have a question for you. Who deemed Orlando the city beautiful?
You can look it up.
Because I've been there, and I don't know if that's what they should be calling it.
Ooh, that's fighting words from the
Well,
No, just kidding here. I'm out here in Southern California, which is why I get to
on that note.
Yep, he opens it up. I mean, it's again out here in Southern California. I'm on this team as well, teaching the infinite banking, and just giving Jason a hard time here. But yeah, we're excited to answer you guys' questions today. Go down to Mr. Brian.
All right, Mr. Brian Fouch here. Yep, I'm also on the Pacific Coast. So Carson and I are holding down the fort on this side, on the wrong coast. I mean, left coast. Yeah, I'm in Central Washington State here, and been doing quite a few webinars this week on infinite banking, which is kind of cool. I know Jason's got one tomorrow. I've got one tomorrow as well. Just teaching the concept and spreading the news about it, and it's kind of cool. What I've been noticing a lot of times on these presentations is that people have heard about it, they've seen other people talk about it, but the way that we hit the Money Multiplier talk about infinite banking is just a bit different. It's a bit more clear, it's a bit more straightforward, and people it seems to click a lot more. So I'm pretty proud of that, and looking to share that tomorrow. So with that, over to Joe.
Up here in Buffalo, no snow, finally, but the sun is shining. And Carson, you shouldn't pick on Jason like that, because I love when he talks about that Star Trek stuff.
Star Trek.
So
out of control already today.
Oh boy, it's gonna be a good day for Jason. That's all I can see coming forward. So we're all here to help you guys. So start throwing our questions so we can have some fun. Oh,
here we go. Joe's losing it. All right, Joe.
That's all you gotta do. You just disappear. It's like peekaboo to Joe. He goes out and he's done. It's crazy.
All right.
Watch, you can't even stop. I'll do it again.
Let's get some questions. Who's got questions? Let's put these questions in the chat box and let's get this show started. Let's see. Tess said, Carson, did you read the Big Black Book yet?
Reading the Big Black Book, yes, currently.
Nice.
And
how about
Carson,
you, Steven?
Let's maybe start there without a Tess. Thank you for that access point, because both Carson and I went through the Nelson Nash Institute practitioner interview, And Carson, how was it for you, buddy? Like how?
Well, for everyone else on here, the Nelson Nash Institute is a group, a certification you can be a part of where you are certified to teach infinite banking. Not everyone can or can teach it the right way. How it was, built with Nelson Nash as the founder. And so this group comes together and comes up with new ideas of how we can teach this to the public and making sure we're all, abiding by guidelines by every insurance company and the IRS and such. But within our group, they accept only certain group of people into this community, and you have to qualify to be there. And so Jason and I, that he's referring to, we met with them and we had our interview with them this week, and I had it today. And honestly, Jason, it was a little interesting. I was expecting to come on here and just have a good time, just meet new people and talk about IBC. But it was pretty serious. I had to, explain myself of why I want to teach this, who I've taught this to already, and make sure that I'm qualified to be a part of the the company. But I thought it was gonna be more fun and get to know one another than it was. How was your experience?
And I just asked because I wanted to hear what you said. Like we got to talk to the author, right? One of Nelson's oldest friends who wrote How Privatized Banking Really Works, which is like 3 times bigger than Nelson's book, right? It's like this thick. It's going to go a lot more detailed into the economics of it, Austrian economics and other things. So I just found it fascinating. I thought it was a really good time. I felt like a little kid because I had seen David Stearns on a bunch of different podcasts and things and heard him speak before. And it was there was a lot of like, well, if we accept you. And I kept thinking, man, guys, you got to accept me. This is what I love doing. This is like a passion. Like, what do you mean if you accept me? But I just kept it like, hey, it's definitely going to happen. It was a lot of fun. So I was wondering if you felt that pressure too. That's all.
It was a little bit of pressure, and now that you're talking about it, I didn't realize how kind of a big deal they were. No, it's pretty cool.
Yes. Yeah, it's definitely
Joe and Brian, are you guys certified?
So next week when I do this, you're saying it's like a 50-50 for me?
Yeah, probably for you, like 30, 65, 70, something like that.
90-10.
Yeah.
Yeah, I'll be starting the process here probably towards the middle of the summer. I got some personal stuff right now I got to focus on, but yeah, I'm going to start that here pretty soon as well. So yeah,
it's pretty intense too. You have to take a course and examination to make sure you can qualify. And I think I saw an email today. There's 150.
You have to write a thesis. You have to write a thesis and present it to a couple hundred people. You have to get that approved by a board. You have to go through a whole bunch of stuff, Joe and Brian.
Yeah. That's funny. Well, cool, guys. So put your questions in the box here. Let's get some questions coming in. So Shauna
wants to know, what are some of the goals of the clients that we've talked to this week? So maybe we can go around the horn and talk about some goals or interesting goals.
Yeah.
That have been anything unique?
Debt. Recapturing debt's been a big one. I've had a lot of people that are getting their kind of not in retirement age, but they're getting this, it's 5 or 10 years or 15 years out, and they're kind of wondering how they're going to be able to kind of function and live at that point in time. And then so they hear us talking about infinite banking and how one of the biggest things that steals wealth from you and prevents you from building wealth is actually debt and that interest you're paying out. And so a lot of people have been reaching out to me saying, hey, I've got this debt, but I don't understand how to get rid of it. How do I recapture it? And then once I do, what do I do after that? And so being able to show them that instead of being 15 years out, it's only like 5 or 4 years out from recapturing it all. Then you flip it over into them building wealth and investing. All of a sudden, their whole financial future changes. So that's been a big one. Has been debt for me.
I have a situation I can bring up to everyone on here, and I'm sure some people that are listening can relate to this or might have a similar situation. But this is a client of mine. He's about 60 years old, and he's currently uninsurable. And he just came in a windfall of $1 million. He had a family member pass away. He obviously wants to get as much of that money into his family banking system as possible, but he's uninsurable, and his 2 kids are only insurable for a certain amount because they're not a high income earning family. So there's probably not a way to get that much money into his policy. And so we're planning to fund his policy and get that $1 million into his policies over the next 5 to 10 years. And in the meantime, he wants to use his cash that he has on hand to, invest with, and maybe even use the income from the investment to fund the policies too. But very different situation than most people come into when they're talking with us. So it was fun to have something different than someone trying to pay off debt. Like you said, they had some real money to work with, and they didn't know exactly how they wanted to do that. So he was asking as well what he wants to do with the funds for investments over the next few years as well. And he thought Private Money Club was a great deal, a great opportunity, and he wants to get into real estate. So it was just cool to see him wanting to be a part of everything we're doing and embracing this concept to the max.
I love that, Carson. That's really unique. And Brian would, if I didn't say this, Brian would say it depends, because he's got so many, it's like choose his own story, right? Which is everybody we talk to. Like, what is the thing? And I would say investing in himself, like taking a portion of that and investing himself and knowing that he's the creator and helping himself learn more about whether it's private money lending or something else that he's interested or something he's passionate about, so he can create more money. And as he creates more money, then he can create bigger policies. That's a question we get all the time. Like, what happens if I start the policy here, like my starter policy, and as I earn more, like what happens? Like, can I put more into this policy? Which the answer is, hey, well, can you put 16 ounces into an 8-ounce container? And if they say yes, we can't work with them just saying. So, but then, it's that whole roadmap that we start laying out for folks, saying, well, it's really your journey. And as you build more wealth, as you keep more wealth, then you're going to need more policies. But for him, I think it starts with investing in himself. That could be with that kind of asset coming into himself, like what's he interested? What's he want to learn about? He can go get one of the best mentors that's out there, right? To teach him something. So that's pretty exciting.
That's great.
Utilizing that money would be a great asset, like you said, to put it into an investment to grow, so then he could get more policies. But utilize what he can now. See, some people don't understand. They're like, but if they max out their policies, what do they do with the rest of the money? Well, put it into the investment with the money that comes out of the dump or comes out of the policy. Just because you can't put it all through the policy doesn't mean that you still can't get your money to move. So that's a good starting point there. I had that issue this week. That's why I'm kind of rolling it into both. But they were maxed out with the policy and still had money. I'm like, okay, that's not a bad thing. We're just going to take the policy, what we can, put through the policy, and then take the rest and put both of it to the investment. Oh, okay. That's...
You have such a creative way of thinking about money. Like, you really help people see things differently, Joe, which I think is awesome, right? Like what you're talking about, like you do it this way. You have different ways of solving the same problem. And I think that's something that we're all able to speak into too. And one thing that keeps coming up, it's come 2-3 calls this week where I've talked with someone who has a decent amount of money saved, but they're not currently working or they don't have income.
Yeah.
And there might be some health things going on too. So it's really letting someone know, like, look, I love that you want to do this. I love that you want to protect your money, have it growing in a guaranteed environment that's tax-free, protect the family. And at the same time, like, I know from experience, like, we're going to have to get creative. Like, if you're like, the one case had a spouse and the spouse was like, heck no, I'm not on board. Like, well, hey, maybe you could bring your spouse on a call or have that conversation with her, or maybe share a shorter video, because they're working, they have an insurable body. You had a medical event and you're not working. I don't know how we could help him, right? He's literally like, how can I get started? Let's do this. And I was like, I know you're not going to get approved if we can't show an income, because they're going to say, how are you going to fund this in year 2? How are you going to fund this in year 3? And that's part of being in a mutually owned dividend paying company, is you're going to be an owner in their company. They're going to vet that. So we got to look at how else can we be creative with it. That was one of the interesting ones I had last night. So,
but depending on how much money he has, he can put it into an investment. That investment is going to come back in. He's going to receive a 1099. That'll be a form of income. Next year, he can get a policy because now he shows income.
Yes, well, it would have been him at his age. That could have worked if there was more, right? So say it's 50,000. say it's $500 a month, right, at 12%. And that's what he has to, that'd be $6,000 at his age. It still wouldn't be there. Like it would be getting the spouse on board. So
it's all mathematics.
Yep.
All right, I'll share one before we get into the questions here real quick. This was kind of a unique one that I went through with the team here today on our team call. A gentleman has, call it $1.5 million in qualified retirement plans, and he wants to pass that on, right? He doesn't need it to live on. He wants to pass it on. But then he realized that if you do that, it's going to be taxed. It's going to be taxed at quite a bit down the road. Income tax, estate tax, all these taxes. Once again, this is not financial advice. Keep that in mind. And so he's like saying, well, what's a better way to do this? Then, of course, he heard one of our presentations. And then so I was talking to him. And I said, well, if you take the tax now on a portion of that, so take it on the stronger dollars now, put it in infinite banking and let it grow there tax-free with the death benefit, generational wealth, which is passed on tax-free guaranteed, all of a sudden the numbers he's going to pass on to that next generation are most likely significantly higher than what he has right now in his accounts. And so he realized that, oh my gosh, if I go through infinite banking, I can leverage the money into other assets today because he does private lending, but also pass it on tax-free guaranteed at a 2x or maybe even 3x multiple. So completely just blew his mind as to what infinite banking can now do for him. And he was not aware of that, obviously a month ago. So kind of cool to help somebody come to that realization.
All right. Ready for the next one?
Go for it.
welcome back, Snaggy.
Sean had texted me and says, I think the guys are just talking because they don't think you're paying attention for the next question.
I was in my brain, Snaggy was typing, going, enhance. That's what was happening the whole time we were talking. So.
All right, let's see.
Maybe that's true, Snaggy.
So Mark asks, interest rate cuts September or no cut? As a renter, should you put your savings in the stocks until the housing comes down and baby boomers die?
Disclaimer.
It's a lot to unpack there.
All right. So
I don't have one penny in stocks, so
me either.
I take me out of this question.
Yeah, I actually don't either. So you can take me out of that.
I don't either.
Well, there's the answer right there. If you want one.
On the stock question,
Ding, 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 ding.
One of my really good friends is a really successful day trader and coach, and he's always asking me like, what stock or company do you believe in, Simple? And I'm like, I don't know, man. He keeps asking me, trying to get me curious about it. But I took all my money out and put it actually in Carson's family, into Horizon Trust, put it into a self-directed. So I'd rather be again, not financial advice, but I'd rather be in control of where my money is going, who it's going with, and what's happening with it versus hoping that, like you said, that where should I put it for the time being in stocks and then into housing and trying to guess when certain things are going to happen in the market.
Can you lose money in the stock market?
No. I had somebody tell me the other day, the S&P, just look at the historical data. That's where I want to have my money. Actually said that to me. I'm like, oh, that's interesting. Okay. So
as far as the stock rates, the interest rates, I kind of watch that a little bit, but they believe that if you look at like Morgan Stanley, those kind of companies, I'm reading they believe they're gonna drop. But once again, I'm not a financial advisor. That's just what I'm kind of seeing right there. And the baby boomers die. I can't talk to you about that one.
You're not saying that because it's an election year, are you?
Oh my gosh, that never happens.
No.
No, the markets are natural. They're just like nature. They're not influenced by anything else.
Grows like a big oak tree.
Yep. So.
Next question, Snaggy. What do we got?
Can you bring them up?
At least I'm pretty.
I think you're writing them all, right? You're just writing questions there?
Yeah, I'm writing the questions. So you guys are going to get hit with some crazy stuff in a moment here. All right. Did we talk to Jay yet? Okay.
No, we have not.
See, so he said second lien HELOC with minimum payment is $800 per month, have 1,000 cash flow, and I'm currently using to pay down HELOC. How can I use HELOC to fund policy year after year? He can borrow from the HELOC at 9.75.
Keep putting all of your money into the HELOC. Once there's enough of room, then we can utilize that money for the policy. But the more that you put into the HELOC, your W-2, every penny that comes into the house needs to go into the second lien HELOC. And then out of that second lien, you'll pay your mortgage, you'll pay your gas bill, electric bill. By that diminishing effect of the interest that you're putting in on a monthly, weekly basis because of your paycheck, you're going to find that you will have extra money in that HELOC. When we have that extra money, that's when we can put it into a policy.
Yep. Cool. And then I noticed that Tess and Hope had her answer to Jay. Depends on how much money he has in savings, but options are private money club and income properties. Yes. Yeah. So
wait a minute. Jay has money in a savings account and he owes money in a HELOC?
No. This is different. No, different client.
Oh.
Or no, sorry. No, you're right. Sorry, I was responding back to the first to Mark. Sorry.
Go back, Snag.
Snag.
She's responding to Mark's thing about that. So
I don't see anything about savings.
Okay.
Mark did reply though to our conversation. Yeah, he said, "Where do you guys keep your savings? Where should we put it?"
Yeah. No. So what Tess and Hope were I think maybe responded maybe to him, but obviously get that money working for you. So in savings, it's not working for you, depending on where it's at. If it's in the markets, it's out of your control. So how do you have it growing for you in your control? Well, private money club is a potential option there.
Depending on how much the savings is, my savings starts by every penny going into the HELOC. Once there's enough of money into the HELOC, then it runs into the policy. When it goes through the policy, then it goes into the investment. That's the way my order goes right from the beginning, always. So if there is savings and you don't have a HELOC, then obviously into the policy. But I mean, the optimum number to have as cash value in a policy would be 0 because you want your money working.
And that, I bet you that you say that a lot, Joe, but I bet you still people who aren't yet practicing, that can get really confusing, right? Because we're telling people, like, look where the banks store their money. The banks have $202 billion of cash-rich whole life policies, right? Like, that's one of the biggest places where they're storing their money. They're not putting it in the banks. They don't want their money, insured by the FDIC. They want it in policies. And so when you say, hey, it's moving, like, why are you saying that? I guess just
money in motion makes money.
Yeah, exactly. Money not in motion does not make money. So therefore, if there's leftover, right? So say somebody has already starting to invest and they have 100,000 and they put it into an investment and it makes 12%. Great. That's $1,000 a month that comes back, right? That 1,000 will go back into the policy because that is where the client will store their wealth while they're accumulating it. So $1,000 every month goes back into the policy. And then they have a bonus at work for another $10,000. So that goes into the policy. After 6 months, after 9 months, hey, look, they have another $50,000 in the policy. Now that there's an opportunity for $50,000, they can take that $50,000, put it back out to the opportunity to make more interest that comes back in. So now they're not making $1,000 a month. Now they're making $1,500. $1,500 every month goes back into the policy, and that would be the circle that they would follow.
Thank you, Joe. That helps.
You're welcome.
You even move your arms less now. That's good. There's less making circles with the money. What else we got, Snags? You're like you're at the beach, buddy. You got like the ocean on the wall behind you, a beach tree. Look, I opened a non-alcoholic brew so I could have a beer with you, Joe.
Oh, there we go. There we go.
We got a Run Wild IPA. Pretty decent stuff. So.
All right, where are we?
That's a good question.
Eric said, I was right in the middle of applying, just got my medical exam, and I got laid off. I assume I need to put the brakes on my application until I'm employed again. Agree?
It depends. How employable are you, Eric? Like, how soon do you expect to have a job again? I guess that would be, I mean, if you're super conservative, I'd say yes, maybe pump the brakes a little bit. But I guess it would depend on what you thought the market was for your skill set and, how you're going to create more value, and what's everyone else think? No thoughts?
I mean, it would depend on his financial situation. So how much is he putting in? What's his free cash flow? What's his assets? Can he cover it for a while if he doesn't go back to work?
Yeah.
Is he paying annually, or is he trying to do monthly off that? I mean, so there's just a lot that goes into that. You probably want to disclose. Well, definitely want to disclose it to the insurance company. That your income's changed. But as far as stopping, it just depends on your overall situation.
I think it would depend on what you said, if it was monthly or annual, that kind of stuff too.
Yeah. Yeah. So if that's with us, Eric, just get with your agent and kind of talk through that situation. Cool. If you're a licensed agent, can you buy your own policies to use the system?
Yeah.
Brains. That's all you got. Thumbs up.
Yeah. So first off, you have to so not all insurance carriers build policies this way to allow you to do infinite banking. There's, when we design a banking policy for somebody, it starts with the insurance company itself. It has to be the right type of company, the right structures, everything like that. And then from there, they have to have the right products that allow us to design these the right way without mecking them, to be able to get the high cash and all that good stuff. So it just depends, what that looks like. And then to work on our team, you do need to actively to be an agent with us, you do need to actively already be doing infinite banking in your own life. So Triune, it would just depend on a couple of different factors. But once you are an agent and have the ability to do it, yeah, I mean, I write my own policies. I know all you guys do as well. So absolutely. But remember, the system is not proprietary to the Money Multiplier. We teach the infinite banking concept, which is just the concept of how money flows through your financial life and how you fund purchases and how you look at debt and how you look at investing and how you use the same dollar to make money multiple times without any extra work or risk or anything. And so that whole concept is what we do. We just happen to use that whole life insurance policy as the vehicle that allows us to do all of that. Fair enough?
Fair enough. Well done.
All right. I don't know what that is, so we'll skip that one.
I don't either. I was wondering that. It's like, I don't know. Crying, something, scared, not sure.
Let's see. Question for Joe or the others. So Connie said, hi, Connie. Can you address pros and cons of a RLT trust owning the policies versus owning them in a personal name?
Mm-hmm. So when the trust owns the policy, the beneficiary is also the trust. So the money that comes into the trust must pay the policy. So unless you can take money and run it across the river, either way, the money that comes into the trust must be the payor of the policy. So I actually waited 3 years to move my policy from personal into the trust to make sure that I would have enough of money running through on an annual basis in order to cover that amount. So,
and the more Joe that I learn about trust, the less I really know, just to be honest. Like the more I hear, the more that I feel like I don't know. Even though I've had multiple conversations with you and others and things, like she's talking about a revocable living trust as well, versus I believe you have an irrevocable trust. Is that correct?
It doesn't matter if it's revocable or irrevocable. It doesn't matter if it's an LLC or a trust. The money needs to be running through that side of your money because you can't take the money and run it back and forth. So if you had an LLC bringing it across the river back to personal, now that's a taxable event. Or if you take the money from personal and run it over to the trust, that could be a taxable event. So you just have to make sure that you have enough of money to pay the policies on that side of whatever you're doing.
And Joe's not an attorney or a CPA.
No. disclaimer, blah, blah, blah.
Yeah.
Thank you, Tess. See, when I'm in charge, I can put up whatever comments I want.
You can leave that one up for you. You're not pretty, Snags. Handsome.
Jay said, I have 50K available in HELOC, but don't think using it to fund policy would make sense. How much would I use the fund since I technically have 12K annual cash flow?
So you would utilize that HELOC as an apples to apples. That's how I started in the beginning. You would take the 50,000, put it into an investment. That investment would have to have arbitrage, therefore spread. So if you had a 8, 9, 10% interest rate on the HELOC, you would have to find an investment that would cover you for that opportunity cost to make you more money. That's how I started with Chris. So on the first $250,000 that he asked me for, that came directly out of the HELOC. And after 10 months, I made $10,000 of free money because he paid the opportunity cost, and I was left with $10,000 in my hand. So then he gave me back the principal, put it back into the HELOC, and redid the process again. Started it over.
And Jay's at 9.75%. He wrote that earlier. So he'd have to have the arbitrage, the spread to be bigger than that to make it make sense. So
12, 15, 20. There's a lot of those on PMC.
Cool. Connie's good. Thanks. I get that's the mechanics of the movement. Was wondering what might be the pros cons of owning it in their name versus the trust.
The pros or cons of owning it in the name.
Well, I mean, Joe, what I would say is like, so life insurance, depending on where you live, but life insurance inherently is protected. So, protected from bankruptcies and judgments and liens and things of that nature. The death benefit gets passed on tax-free as well. So there's no issue there really.
But the owner would have to be the trust.
What's that?
The owner would have to be the trust. I said that the last time. If the trust owns it, the beneficiary would be the trust.
But even if they own it personally, they could still make the trust the beneficiary.
Well, that's a revocable. So I guess it depends on who the beneficiaries are.
Or the type of trust, yeah. And then the other thing, though, you could, I think it just depends on the type of trust, right, Joe? I mean, and what the overall family planning strategy is. Because at the end of the day, you can't go wrong either way, really. And one of the cool things is I do want to say this also is don't let the owner of the policy stop you from getting it started, because you can change ownership of the policy really at any time pretty easily. So just keep that in mind also.
It just depends on, where the money is coming. I mean, if it's a monthly deposit and it has to come out of your paycheck, how is that money from your paycheck on a monthly basis going into the trust to have the trust pay for the policy? I mean, it's kind of the mechanics, but I mean, like the difference of the owning, the trust owns it instead of me. So it just depends on what side of the river you kind of want it to be on. So I mean, I have one on that side. The trust owns one, but I still have 3 on my personal side.
Yeah, that's really more of an overall, strategy with your attorney, with family planning and estate planning, and what the overall picture and what you're trying to accomplish. I mean, are you trying to control that money from the grave? And what happens, what a lot of the wealthy families, they'll leave the money into the trust. The trust is then instructed to buy more policies for the members of the trust and, continue it going that way type situation. Or maybe some of the money's released at certain ages or certain times, or, you can really set up those anyhow you want. So
I think that's the best answer, Stephen, is it depends. And it's really what is she trying to accomplish? And then going from there. Because if you know what you're trying to accomplish, it's a lot easier to go out and get the kind of advice you need, right? Because Joe's saying, hey, I got 3 on one side, 1 on the other side. And I immediately thought, well, why? Right? Why? Because Joe he knows what he's trying to accomplish for his family, for his situation. So Connie, that'd be the root, is really knowing what is the outcome, what's the big vision.
All right. Where should Tony and Angie get a HELOC?
Depends on what your mortgage is. It depends on all mathematics. Are we going for a first lien? Are we going to just do a second lien? How much is it with our mortgage in escrow? And how much is the extra with our second lien HELOC? How much are we going to get? How much can our LTV handle? Can we go up to 90%? Can we go up to 80%? We have to run the numbers and come up with a calculation. That's kind of what I have to tell you. It's all mathematics, right, Jay?
That's right, Joe. And the banks will make sure they're asking you lots of questions, and they ask the same questions over and over again, even if, So this is another reason to have a policy. There's no hoops to jump through. You can take out a loan if you have cash value whenever you want for whatever you want, and you don't have to jump through hoops.
It's a great way to utilize OPM to climb the ladder faster. If you can fit in the little box and climb through a couple hoops.
Yes. Yeah. While juggling plates and spinning plates and juggling and doing all the other stuff too. So
if you send me an email, I can do a strategy call with you and see if it would benefit you.
Cool. I'm waiting on questions.
look at that.
Anybody want to share any stories? Maybe share that one about the other insurance company and the way that client was led down the path of.
Yeah,
most
I can share that. Yeah, so
be careful out there.
Yeah, so a client about a week ago heard about infinite banking, was very interested in it, and they had talked to another insurance company, which I'm not going to name. It's not a bad company, I think that. And they went directly to the insurance company and went to an agent and said, "Hey, can I get a cash value life insurance policy, something like infinite banking?" And that person said yes, and gave them a policy and tried to explain to the client. The client didn't understand what they were saying. Was like, "I'm very confused." Then this person saw a presentation that I did here. I think it was yesterday. I think it was that one. They were on that one, and was like, "Okay, this is infinite banking." And then called me up. We went through it, but they were very confused about the numbers and stuff. And we pulled up this other policy. She actually showed it to me. And we as licensed agents have to be, we can't be totally biased. We got to be very straightforward with what we see. And so I said, that is an infinite banking structured policy, very inefficient, very inefficient. And I walked her through the numbers. And this is kind of where you got to be careful of who you're talking to when it comes to infinite banking. I said one thing. I said, "Now, did you ask this person if they do infinite banking?" She's like, "Well, no, they don't do it." I'm like, "Well, then in my opinion, you're talking to the wrong person already, because they're not doing what they're giving you." Like, I would not give an IUL or something like that to my parents or my family. So I wouldn't give it to you either, or myself. So why are they giving you something that they wouldn't use themselves?
That would be like going. That'd be like going to a hand doctor when your foot hurt.
Yeah, exactly. And
Why
so
would you do that?
Yeah, and so and additionally, this person couldn't explain how to use the policy as infinite banking because they've never done it themselves. How do you borrow? How do you recapture debt? They had no knowledge about that, so this client was left kind of in the dark. And so I walked her through that policy that she saw there, and she's like, "That is, I doubt that's amazing. I didn't know that." And then additionally, I created a policy at the same time I'm talking to her. I'm talking to her about typing up and created another one that was truly infinite banking, and then sent that to her and said, "Here's a true infinite banking. Look at the numbers." And it was very different, meaning there was a lot of early cash value, better growth over the following year. So the thing, the point here is just be careful who you're talking to. If it's somebody else and not us, that's fine. Just make sure that they are doing infinite banking. They understand how to set it up and they use it themselves. That's just my opinion, of course. But that's all we do here. Like this individual that they were talking to sells annuities. They sell IULs, they sell whole life, other products. And so they're going to typically, and this is just my thoughts, they're going to pitch the thing that might be the best for the agent, but not the client. So that's very prevalent, by the way, high commissions, stuff like that. So it was an interesting conversation, but that client was completely flipped on their way of thinking, because they were thinking this is not a fit for me. After our call, they're saying, okay, I'll let you know I'm ready to move forward here next week. So
When dealing with money, I find it, why would somebody go to somebody that isn't actually doing it or practicing it? Like, oh, I went to my lawyer and talked to him about trusts. Oh, does he do trusts? No. Then why? I don't understand. Does he have a trust? No. Then why would you go to him for a trust? He doesn't have one. He doesn't know how to make one, but you're going to go to him to do one. Why would you go to someone for IBC if all they know is term? I don't understand.
Yeah, and then one thing also that when I was talking to this client too, to your point, Joe, is that like that other person and this is, by the way, is the insurance company. And I told her, so if you went through us or go straight to the insurance company, the numbers are exactly the same. It doesn't change, except with us, you have the resources of our entire team, the ongoing services, the ongoing support, the education, all of these things that stack up. And she's like, and then we started thinking about it. It's like, oh my gosh, the value kind of changed quite a bit. So
It amazes me when people meet with us and they understand exactly what we do, or they think they do, and then they talk to their financial advisor or buddy and they end up saying they want to go different ways.
Mm-hmm.
It always amazes me, because it's like, what are you getting from them that we don't provide or we don't know more about? Like it just boggles my mind every time.
I think, and it is mind-boggling, Carson, I'll agree. And I think it goes back to, where is that person on their journey? Like, where are they in really their actual research and taking ownership? Because it's all about agency. At the end of the day, what we teach is we give someone agency. We're like, hey, this is for you to control. Like, we don't want to control it for you, but we will hold your hand. We will walk you through it. We will, whether it's our application specialist, all of our applications, but anybody in the Money Multiplier that's helping you is a actual infinite banking practitioner. Whether it's one of your mentors, whether it's your application specialist, whether it's your implementation specialist, whether it's someone putting in data. So that just shows what the culture is, right? And so when someone like goes to someone else, they're probably just not the right fit, or they're just not ready yet. Like they haven't been around it yet enough.
What about mindset?
Well, that's it. It's where is somebody in their journey of the mindset. And like we talked, remember, Carson, like you brought up the 4 stages. Like some people, it's a glorified savings account. Some people, they're doing one specific thing, paying debt, buying a vehicle. And then you get to the next stage where they're like, I'm all in. How many can I have? How many banking policies can I open? And then you get to the next stage where that's your lifestyle. That's it. You're just teaching and doing and flying all over the country. And now you're Brent or Hannah or any of us that we just speak about infinite banking nonstop. Now, I literally finally had a breakthrough. I was so excited for one of the guys I cycle with. He has an older, regular old whole life, but it has a decent amount of cash value, close to $30,000 in it. He owes about $30 on his car. He has a $700 a month payment at 6.5% on a new car, like 6-month-old car. And I was like, brother, that money is just sitting there. It's not doing anything. It's a non-direct company. It's a company that used to practice infinite banking. It's been around for 150 plus years. Take the loan, pay off the car, and pay yourself back. Just do me a favor. So he was going to make that phone call today. This is the 3rd or 4th time we've talked about it. So he finally, something clicked today. I don't know why, because I didn't say anything differently, but something clicked today and he was going to do that. So that's pretty exciting. So.
Yep. That's awesome when I'm on the phone with somebody and I hear that in their voice and they're like, oh, they had their aha moment. That's the best.
It is, because you can hear when it's not there. I talked to someone for 55 minutes, almost an hour today. And it was the same question over and over again. I just don't get it. Like, if I'm taking a loan against the money and now I'm paying interest to the insurance company, how does that benefit me when I could just take the investment as a real estate guy? Why don't I just take the investment and put it right in and I have all the money working right away versus putting it here first? And I kept talking about how it's either an or strategy or an and strategy. Which one do you want? And he's like, I want to get this. I just don't get it. And I could hear it. I could hear it the whole time. I said the story like 8 different ways. Like, I basically thought about all of you guys and all the different stories we tell and said, hey, I told this way and this way and this way. And I'm like, I'll just send you a bunch of stuff and you can read. Like, here you go. Like, keep learning.
I have a quick way. I have a quick one. Jason, you and I are driving on a trip and we're running out of gas. So we pull into the gas station. You pull to the left side of the pump. I pull to the right side of the pump. You put in $100. I put in $100. We both go in to pay. You take a $100 bill out of your pocket and you hand it to the cash register. I take out $100 and I hand it to the cash register. How much did you spend?
$100.
How much money did I spend?
Well, $100.
No,
It's not my money. My money went through the policy, took it out of the policy, put it into an investment. That investment came back with interest. That interest is what's in my pocket. You spent your $100. I'm spending my interest because we ran it through the policy, put it into an investment, and make our money work for us. That's one that you could have sold. Maybe 2 for next time.
I will practice that one. I will practice that. Good one. Carson knew the answer.
Yep.
Yeah, Joe gave me that one a couple years ago. Blew my mind. And then he told me, do you live off of principal or do you live your life off of interest? And I was like, I don't know. Blew my mind again. You live your life off of interest. You never live your life off of principal.
Never spend principal.
Yeah.
Put your principal to work. Make interest. Have somebody else pay for you.
That was good. Anything else?
Wrapping up a little early today. I like it.
Yeah, I got some food to eat. I got some.
You're on mute, Steven.
There's actually lots of questions.
Oh.
You want to rapid fire a couple?
Let's do it.
Yeah.
You take a nap? Do we wake you up?
How long? How long is the typical forklift investment return?
I did 7 of them at once, so there is no typical. Mainly around the 4-month, mark. A couple of them at 2 months. 2 of them at 4 months, or 3 of them at 4 months, and then there was a couple stragglers, 1 at 6, 1 at 7, 1 at 9. It just depends. Maybe one of them was too big, maybe one of them was too small. Just depends on the season. Typical is about 3 months.
Is it 3 bears or is forklifts? What are we talking about?
I don't know. Whose porridge is it?
All right, now we're rapid fire, Snaggy. Come on, stay with us. What's next?
So I was reading it. All right. Hey guys, on the forklift thing, you should plan on being in for a year. I'll say that. Even if you get it back, you should probably consider rolling it into another one in about a year time frame is kind of what he's looking for when it comes to investors on that. All right. Hey guys, how long does it take for the insurance company to change ownership on a policy?
Not long. I forgot exactly the time frame that it took me. A week, maybe 2 weeks tops, but I'm thinking closer to a week.
Should we be receiving regular statements from One America? Currently, they only get premium invoices. I think you get a policy anniversary. On your policy anniversary, you'll get something, but not on a monthly basis. If you ever need anything, just log in to your client portal on One America, and everything's right there.
Yeah. Well, I don't know if you would need a regular statement.
Why are agents reluctant to do IBC with old people?
I'm not. I do it all the time.
Just like I do them on myself all the time.
Yeah, really.
It's kind of hard to make it be attractive to them. So if you have 10 people that are, say, 70 and 10 people that are 40, more people at 40 years old are going to do policies versus at the older age. So they're for those individuals, those agents, it's just where they spend their time. Probably they're looking for ROI on their time.
Yeah. So the agents that you're talking to aren't the 5 of us.
Correct.
Oh,
Yeah.
I guess that's kind of the answer.
Yeah.
The difference, if you have an 8-year-old and an 80-year-old, and they're both putting in the same amount, they're still going to be doing infinite banking the same way, except the 8-year-old is going to have a lot more death benefit than the 80-year-old. Other than that, setting up for banking purposes, it's equal.
Yeah. Also, they're not solving problems in that case too, because it doesn't matter if they're 70 or 40. What are we trying to solve for?
Exactly.
Like that doesn't mean it's on them. The policy can be on a spouse, adult kids, grandkids, business partner. So it's because they're not digging into the real reason why we were doing infinite banking or why they want to do it. That's just our opinion usually.
So I guess you're talking to the wrong agents.
Yeah, there you go.
Come on, Snappy.
Could Carson's client, 60-year-old with the windfall, put his money into a trust and start policies with his children?
Guess he could.
Sure.
It's going to depend on. It's going to depend on the children's age and their income and the different things. It's going to be on their body, even if it's coming from the trust, right? So it's still going to be based on their income, their specifics, their health, all their things. So he could be funding it, right? Could do that with the money, but it's still going to be based on them.
But you wouldn't want the money just to sit in the trust. You would want the money to go into an investment to make more money. So you always got to think about that. We're not just leaving money in a trust. My God, I don't leave any money in my trust. Everything gets moved.
What is the video referred to last week that explained infinite banking in 4 different ways?
Carson.
Is that what the 4 stages of IBC?
Yep.
Yeah.
Okay, I'll find the link.
James, a great question. It wasn't more like in 4 different ways. It was more of like the journey of what it looks like as you get deeper and deeper into it.
There it is.
Yeah, correct.
All right, let's see. Just likes and understands. Asking, okay, cool. Here's one. Asking what you each would charge. How much would you charge family for holding a mortgage to a property? What factors would you take into account looking for me to hold for 3 years?
That's a very in-depth answer and question right there. There's a lot of parts to that. When I used to do subject to, which means I'm creating the notes, I would always raise the property more than a comparable property because I'm owner financing it. But it depends on if that's what you're doing or not. And then the rate would be higher too. It has to be, it can't be, there's restrictions in certain states though. Can't be like 10 points above. It can be a few points above current mortgage rates, but I was doing 10% mortgage rates and, about 10% above comparable values. But that's because I was providing the owner financing. So there's a benefit to that. They don't have to get qualified because they couldn't qualify for traditional mortgage.
It's a big benefit. I mean, when it comes to family, it's up to you. Like 8 to 12% in this market, I think is fair. If you're really hooking them up, 8, if you're looking to do it more typical, maybe 10, 12, like you're saying. But more importantly than any of that, regardless of the rate, just make sure you have all the legal contracts and paperwork done just like it was not family. Because if you don't do that right, it'll rip your family apart if something happens. And, if you have the paperwork in place and it's like, hey, sorry, it's business, so, that's the best advice I can give on that one. But that's the cool thing about infinite banking is you're in charge, so you decide how much you want to lend at.
Yeah.
If it's kids, I can tell you, if you do it like the Kesslers, the Kesslers, Brent does that for his kids. He holds mortgages for them on their homes, and he charges like 9, 10, right, Joe?
13%.
13 on one, but you got to remember the kids are happy to pay that because what's happening with that money? It's going back into their family banking system that they know they're going to get one day. So, you got to look at big picture. And if you train your kids and teach your kids, if it's not kids, that's a different situation. But yeah, absolutely. Cool. All right, guys, 5:32. Thanks for all the questions. Good stuff. Hopefully we got them all. If not, we'll be here next week. Some of us will be here next week. Somebody will be here next week. See some of you guys in California. Hope everyone has a great rest of your week. We'll talk to you soon. If you need to schedule a call with us, mentors.beyourownbanker.com. See you then. Thank you. Adios. Have a great day. Goodbye. Thank you.